Once again, good morning and welcome to the weekly life insurance sales training webinar provided to you by the Messer Financial Group out of Charlotte, North Carolina. Mark Contra here with you. And a couple of little housekeeping items as in the past. Be sure your phones are muted just in case. If you have any questions, you'll see on the left-hand or on the right-hand column a little box marked questions. You can go in there and place those so that when we finish the presentation this morning, I'll be able to come back and address any of those questions that you may have. What we intend to do today, as you can see on the screen, policy delivery. During this year, as you're aware, if you've been with me for a number of the other presentations, we're trying to assist you as agents in the preparation for the psychology behind and the actual activity of making life insurance sales. And we did start from the very, very basics of marketing yourself, carrying that into the structure of appointment setting. From that, we developed a way of obtaining health information on the client that would enable us to do a better job at our field underwriting. We visited with the family, our imaginary family of Thomas and Louise Anderson, and during that visit we prepared a fact finder. Now that we had gathered that information, of course, we went back to our office and we put together a program that we thought would be the best fit. And when we had gone through the process of how to quote, we used both the tools available from your Messer website as well as the WinFlex products, get you attuned to how to work with permanent type of products, which will be worked for us as we continue on with the training. And once we had gathered all that information, we went back to our imaginary clients and we did a presentation. What we developed over these past couple of weeks was a desire to work with products that sell living benefits. And what I have mentioned as in the past is that fortunately we have three very strong carriers: the American General Partners Group, Transamerican, North American, that do provide living benefits with their life products. We also have had the benefit of North American, with Charlene assisting us doing presentations of information to you as agents that was truly sales developed. We've gotten completely away from just having a webinar with companies that are here to present their products and tell us how great they are, but not assist you in being able to make that sale. So we've kind of put that caveat on each of the carriers when they desire to get involved with our webinars, that they have to be able to present something in a fashion that's going to enable you to do a better job selling. We even started way back in the beginning working with the GTL products with Mike Gundy, who actually gave you some ways to handle objections, which was great. It was a little early from the stages of the presentation, but again, even though his basis wasn't on life insurance, it was actually on the types of indemnity products that you might add to your health portfolios, but it was sales oriented. So again, that's our focus. We want to be able to help you make sales. Fortunately, I just came back from spending a couple of days in Atlanta, working with agents there directly on a one-on-one basis. And we're going to do that same presentation here in the Charlotte office next week on Monday and Tuesday for agents locally that have the availability of the time to spend with me for a 2-day period of time. And it's pretty much accumulation of all the information we've been sharing thus far and then going into the next steps. Now, during these presentations in the weeks past, we of course have recorded them. So even if you've missed any of these steps, you'll be able to go back to the Messer website, to the Agent Resources Center, and you'll be able to open that up in the drop-down screen and find that Learning Center. And you'll be able to open that window and look at Just Added. Just Added is the section as we add new webinars. Now, I bring this to your attention this early today because we are working, our communications department, on an updating of that entire site. So I'm saying with caution right now, if you go to that site, you're not going to find the most current presentation, that which was done 1 week ago. And that was reviewing or looking at the policy that we had applied for on the website of the carrier and looking at what things you as an agent would have to do. Also, I mentioned the 3 carriers being North American with the living benefits. Their products have living benefits only on the permanent side. So it has to be getting into the UL products to have those living benefits. Transamerica and American General Partners both apply those benefits on their term products. We've come to use the philosophy now that when you're working with clients, you've got the advantage to ask them if they have insurance, and they say yes. And you're going to find out if they have permanent or term, and they say term. And you're going to ask them if they have the new term or the old term. And you're going to give that eye-opening question so that they come back and ask, you know, what is the new term? And of course, that is the term products with living benefits. Now, with our imaginary couple, Thomas and Louise, the best fit for them was the American General Partners plan. And based on our fact finder, based on their household income, based on their financial situation and needs, we had determined that we were going to do a policy on Thomas for $1 million for 20 years with the living benefits, and on Louise for $750,000 with living benefits. And we also added on Louise's policy a child rider to protect those children that we found in the household, who we probably will come back at a future date and write child policies on them. But we wanted immediate coverage as we started the parents on their protection. And we also made sure that we added the waiver of premium benefit to both Thomas and Louise's policy. Now, obviously, they were imaginary. We carried them all the way through to the point that we did not submit their application, because that would have created a little bit of havoc of me trying to pull it back off the system. But we did go through the steps. And again, you'll find all of that in the back history of the webinars that we've done. So what we're going to do today, as we discuss the policy delivery, is we're actually going to look at one of the policies that was recently delivered. And this policy was designed specifically, again, based on the needs of this household, which happened to be a single person, a mother with 2 children, working mom, wanting the protection again for those 2 children. I'm going to break this policy delivery program up today into 2 sections. The first one being the actual paperwork. When you get the policy in the mail for delivery, and again, we're talking about in the mail, I still like that face-to-face experience with the client. And again, as I have brought to your attention, I don't believe life insurance is a one-call close. I've often said it's a minimal of 2 or 3. And as you're going to see in the situation that we've developed, again, imaginarily with Thomas and Louise, we met with them once to gather the vital information. We came back with a plan. We presented the plan and were able to obtain an application from them, which we submitted again and did our follow-up. And now the policy's been sent to me, as the agent to deliver to them. So here I am coming back to their home for the third time. So again, if we'll carry that forward, when you receive this policy, the typical format with all carriers is it's a nice folder. On the right-hand side is the policy itself. On the left-hand side are pages or documents that need to either be signed or presented as an attachment to the policy itself. And that again is where we're going to start today. We'll start with this client that happens to be a real client. And as you can see from the information, this young lady was just about to turn 50. And what we worked with her, and again, this is just a readout, okay, but this really tells you everything that's happened with it. It's $1 million policy. It does have the child term rider in the amount of $25,000. It has the waiver of premium, in this case, abbreviated premium waiver. And of course, most importantly, it has all the accelerated benefit riders that we've talked about and we will continue to talk about in greater depth today, as we will going forward. What's going to happen in the next weeks ahead, one of the presentations will be from American General Partners strictly on these benefit riders. I'd rather have them give you a lot of the ins and outs, again, from a professional standpoint from the carrier, because I believe this information is to be shared with the family. Even though you have consummated a sale at this point when you're doing this policy delivery, you want to be able to lock everything in. And by locking everything in, you're going to guarantee yourself that the policy is going to remain in force, and the work that you did for the benefit of your client will always be there to benefit those beneficiaries. So again, as we can see in the case of this particular document, the cost of the actual insurance for Samantha would have only been about $1,500 for $1 million worth of coverage. Once we added on the waiver of premium, the child rider, we came up with a total cost of $2,042.50 a year in premium. Now, she has the option, as you'll have when you present it. You may have already stipulated with the client that you're going to do bank drafting and it's going to have a monthly premium of $178. You could have them billed monthly, but I say please don't do that. Avoid that circumstance, and that premium is just a couple of dollars more for the cost of servicing the monthly billing. Minimally go with bank drafting monthly on a client. They could pay quarterly, semi-annually, or annually. Now, again, as an agent in the field and working myself, I always want to secure my commission, as you will also. The carriers will normally pay a 6-month advance. So on your commissions, if you were going to be collecting only the monthly premium, you could possibly be advanced on the total premiums of a half a year, semi-annually of $1,051. Again, based on your commissionary structure. Just for simplicity and practical purposes today, I'm going to use the 100% factor. So then you would receive that as your commission. Now, of course, you've been advanced, so as the client is making those payments, you're kind of paying back their debt, your debt that you've created. Also, I say, though, when the day comes and you find yourself secure to go off and accept as earned, you're increasing your own income, because when you do advances, you are paying a fee for that. And basically the fee to the carrier for doing that is approximately 1 full month of commission. So by accepting your commission at $178 a month, you've probably actually lowered your entire commission, again, based on the 100% factor that I'm using today, to about $1,975. More than that, $1,875. So it does make a big difference going advanced or as earned. If at any time you're able to present it in such a fashion to your client and it makes sense for them to pay the entire premium, in this case the $2,042, in one lump sum at the time of delivery, your advance, of course, is the entire year paid and you're totally paid up. I do want to make sure that sometimes agents don't understand when you do a life product, and again, even though I've got a 1-year payment design here, you want to make sure that that 13th month payment is made too. Some carriers will actually go back and charge you back commissions if they don't receive the 12-month plus 1. Now, it won't be entirely, the whole commission won't be charged back, but any portion that might be charged back, you want to try to avoid. So it kind of forces you to do the right thing as an agent, which is doing your annual policy review, which of course is one of the things we've talked about in the past, and we're actually going to do a webinar on the annual review that's going to come up shortly. And again, we're going to invite Charlene from North America to come in and do a presentation in that manner. So all of these things, sometimes I get a little bit off track, but I'm just relating to you things that I know being an agent in the field and making sales that are important to my career, as well as they'll be important to yours. Okay, so basic document, start up. Also, you're going to have a document that explains the statement of the policy costs and also the benefit information. Sometimes this throws agents off because, again, we have a 20-year and it says renewable level benefit term life insurance. Okay. Additional 1-year provisions are available prior to age 95. It tells us that it's convertible prior to the 16th policy anniversary or age 75, whichever would come earlier. Now, this is a very basic part of convertibility, but it's one of the things that's very important as we're talking about consummating the sale and the benefits that you have provided to them and why they want to do business with you. You want to be able to sell policies that offer a convertibility. You also want to be able to sell policies that offer a convertibility, as does American General Partners, to any permanent product in their portfolio. So you're not limited, okay? Some companies will limit you to certain products, or they won't even be specific. And all that information is provided in this policy as you go forth to do the delivery. So always make sure you're trying to do everything in the best interest of your client. What I was alluding to when I said what throws agents off is they know they have a 20-year term and they look at this page and they see, okay, there's that premium, that $14.95. And again, that was strictly on the premium for the policy that you would have noted. Let's go back to that slide. On the cost of the insurance to the insured. Has nothing to do with all of the additional information here. And the reason that is because at a certain period of time, those benefits like the child protection are going to drop off anyway. But what it does say is on year 21, if for some reason the insured wanted to keep this policy, she could. Of course, it would be at a huge cost. Currently, that cost would be about $27,500, but they also give you a premium maximum that it could possibly be. So it could be as high as $32,000 to keep that policy for 1 more year. And then again, they show $30,000, $33,000, years 2, 3 after expiration, and it continues to accumulate over time to the point of that high number. Now, you're probably sitting there saying to yourself, who in their right mind would pay $27,000 for 1 year premium on a term product. Well, on a rare occasion, it will happen. And again, bringing to you personal life experience, a dear friend who I had written insurance with also had a policy written with another agent before he had met me. Anyway, it was an imploding UL, and by that I mean that the flexible premium was increasing faster than the cost of insurance, and the benefits that the policy had were disintegrating, and the policy was going to come to an end. Anyway, there was enough cash in the policy, and he wanted to do something with it. And most agents probably would have suggested that he move that money into another policy by an exchange, but I did not. I did not because, number one, the amount wasn't that much. It was, I'm going to say, around about $3,000. Anyway, I said to Jim, let's just get started on the new policy, and let's just let that policy ride and see, it just increases your household coverage for Linda, his spouse. And after a little bit of boxing, we finally got to the point where he agreed that that was a smart thing to do. Now, of course, no knowledge of what the future could have in store, but about 2 years later, Jim was diagnosed with a terminal situation. He had a brain tumor, much like our dear friend Neil that we recently lost. And he had this policy still in effect. And Jim was starting to lose the capacity to make good business decisions, and Linda had called me, and it had reached the point where there was going to be a significant increase. They had run out of funds that was in the cash value of the policy that were being used to pay the premiums, and it was going to be time now to pay the piper. And she asked me if it made good sense. Well, the relevance of the situation was the policy was for about $500,000, and at that time, the premium was going to be about $6,000. And I said to her, without a doubt, Linda, it makes very good sense. We know Jim is terminal. He can't get insurance anymore, number one. It's a good thing we didn't drop it. Yes, pay the $6,000 and keep that policy in force, which is what took place. And of course, at the time of Jim's death, she had both the policy that I had sold them the 3-year period before, as well as the policy that they had just kept. So there are times that actually becomes a benefit. So here in this case, obviously it's a lot of money, but the same way, if somebody were diagnosed or had serious health issues, even if it cost them $100,000 over 3 more years after this period of time to pick up the death benefit of $1 million, it would be certainly worth their while. Also, it shows that we have in the statement of policy costs additional benefit information. We've got the waiver of premium, and that's for $400 a year. Then we go into a disclosure, and again, this is all the paperwork that's sitting at the left-hand side of this file that you're presenting to the family at the time of the policy delivery. Now, I'm not going to go into detail on these benefit descriptions here on the summary, and I'm going to tell them that because I'm going to go into this benefit for them as I go into the policy itself in detail. Now, we do have a polling question, and Rebecca, with your assistance, could you bring up that first polling question, please? And of course, the question is a very basic one. Have you had the opportunity in the past to present and deliver a policy? All right, we've got about a 70% participation of attendees today. I guess I've lost a couple of people off to the side, or They haven't decided how they would vote, but as the poll shows, about 56% of you have and 44 haven't. So it's a nice mix, 50-50 basically. Have or have not delivered a policy. So again, the summary of the disclosure is just that, a quick little summary. Also, based in that summary itself are additional information. A basic notice. And then we have the letter from American General, in this case from Deborah, the Vice President in Customer Service, acknowledging the fact of her policy being delivered and that she will need to, as she did, sign and date the receipt of this acknowledgement, which is the document that I'm going to need to turn back in to the carrier so that they can see I have delivered it, as well as when they receive their premium, are going to pay me. Now, as it says, there was a necessity for an alteration in the application. And the original application we're going to see is attached to this document later in the presentation, and that she again needed to understand and agree that the original document needed that alteration. And I'll show you specifically what that was. So again, she has to sign it as the applicant and owner. In this case, she's both. Necessity of my witness and the date, again, of the submission of this particular document. February 20th, February 20th. Make sure your policy delivery documents always have the same date. Then on the acceptance of the amendment on that application, here's what it goes into. Again, the primary insured's name, what her information is applied for, and this had to do with the medical exam, the annual visit, and the determination from those that there were no problems. So again, that was the little amendment they made to the application, which came from the Part 2 documentation, or actually from the examiner's presence. So again, a signature and a sign off on the acceptance of that amended change. Here's my little receipt showing the address back to American General Partners. I always make a copy of any delivered documents just for my own personal file, and always have that type of a receipt when sending the documents on. In this case, this document went on with a check, fortunately, in the entire amount for the policy year, so that when all was received by the carrier, of course, I was able to obtain that commission. Second part we're going to go into now is the actual hard copy of the policy. And this is what you would have before you. This is what you're going to be leaving with the client. And this is where really the blood and guts of what you've done in their best interest is all brought to their attention. So let's begin with that policy. The first page itself, the cover page, again shows our insured, policy number, date of the policy. That was the date that it was issued from the insurance company. Now that date actually becomes the policy date of being in force. So in this case, if you recall, let's go back on that screen, was not able to consummate the delivery on this. I won't go into the details until the 20th of February. However, the policy literally was in effect, so that when I went back and finally did collect the premium, it is dated for December 28th, and her annual renewal then will be December 27th of 2017. It was set up for that initial premium, as we discussed, even though she wound up paying the annual, but it was structured that way, which is part of the changes actually that took place and delayed the timing. Inside, behind that cover page, is basically your contents. So it gives you the whole layout of what's going to be there and what page you're going to turn to if you ever needed to find that information again. So everything you need if you're looking for information on a beneficiary, the effects of it in a policy, death benefit payout, grace period, suicide exclusion. All of it's going to be there page by page. So again, as we start with Samantha here today, we're going to show that full policy amount, the full annual premium. We're showing that she's receiving the waiver of premium benefit and the cost of that waiver. Now, you might note here, we have a 20-year policy, but we only have 16 years of waiver of premium. Probably should have put that in my polling questions. Do you know why we only have 16 instead of 20? Well, the reason is she'll be turning 65, so the waiver of premium benefit for disability disappears at age 65, 16 years from the date of her application. Okay, that's what it is. Remember, too, we added the children policy, and we added the $25,000 benefit. And it shows each insured child 25 units. Someone brought to my attention, or in the meeting in Atlanta, they were questioning this, and we had to go through, and you'll see here in detail where it is. But when you buy child protection at that set amount, it doesn't matter if there's one child, two children, 3, 4, 5, 6, 7. Does not matter how many there are, and the rate is the same. If, again, you're doing your work as an agent and you have a family you have helped and they have the 2 kids, and you do your policy review a year from now and you find out now they've got 3 kids, you want to go back and document that. You want to send in the paperwork necessary to add that 3rd child, and there is no charge to the family. It just becomes a part. It's a rider to the actual policy after issue. Again, signed off by the policy owner, in this case, the insured Samantha, and is signed off by you as the agent. Always do that, and all children are covered. We'll talk about the coverage itself. We also see, again, with that waiver of premium for that total disability, the same expirationary period, 16 years. And now, and most importantly, we begin to talk about the accelerated benefits, the living benefits that are going to become available to that person. And we know that in the past, when we've talked about benefits of this nature, you've always heard about an accelerated death benefit. And once it started, the other companies also jumped on the bandwagon, so that to this point today, it's very hard to find a company that offers a term product that doesn't have that accelerated death benefit. That's the benefit that if someone is diagnosed as being terminal, that they can access usually 50% of the face value prior to that death, and then use that for whatever those personal needs may be, from anything from medical to just personal time with family. And then, of course, whatever amount that they do decide to take is going to reduce the face amount of the policy or the death benefit at that time in the future. But that has always, or has become now, a very generic benefit added with all term products, and there is actually no cost to that benefit. And that, again, is the accelerated death benefit. But today we're going to talk about the additional benefits that are included in the benefit riders. Again, we get that breakdown of that cost of the insurance, how it would increase. We saw on that first page just a couple of years example, but to give the complete detail, here is the schedule for the renewability of that product, annual renewable term at that point, and how much it could cost. So technically, without me adding up all the numbers, even under a grievous situation, it looks like there's probably at least another 11, 12 years that somebody could make extremely high payments to keep the policy that would pay $1 million benefit, 100, 200, 300, 455, 6, 7. So they could come all the way out here and paid in about 700,000 still to get back $1 million in return. So not a bad deal if that happened to be the situation. All right. Conversion. Remember we talked that they would have a conversion benefit. Very important to know, and then be able to explain when it expires, etc. And as you can see on the date of this, we've got conversion credits that expire in 2021, but the conversion option itself doesn't really expire until 2032. Okay. Just kind of looking at it to see if there's anything else I needed to add here. Okay. There are little things that say, you know, hey, if the insured dies within 2 years of the date of the application, the statement concerning tobacco and other nicotine use was incorrect, then the amount payable under the policy actually is going to be corrected. And how that would be is based on the premium. In other words, somebody cheated and said they didn't smoke, but they did, and then they die of lung cancer or something. They're still going to pay, but they're going to make adjustments as to what the cost of that insurance should have been for the period of time that they owned it, that they didn't pay the proper premium. Okay? But they're well beyond the 2-year exclusion clause, which we'll see in just a moment. Some administrative information. And again, with the Partners product, we're not working with the home office of American General. We're working with the administrative assistance offices in Nashville, Tennessee. Talks about who the owner is, just a broad definition of an owner. Should be 18 years or older to have that ownership right. Talk about a little bit about beneficiaries. Beneficiaries could be spouses of the children, others, but again, it's just, this is generic. How to do a change of ownership or beneficiary, and knowing that it can be done with an endorsement. Again, it's another document you can use to or access and go back to the family at a future date if you needed to change the ownership right or change the beneficiaries. Obviously, one place that could happen is you could have a client who winds up getting divorced and takes the spouse off of the policy as a beneficiary because it was not a mandate or not ordered by the court that that spouse maintain that beneficial interest. So that would be a place you might make a change of beneficiary. You also might make a change of beneficiary if you don't set up a trust as you add more children into the secondary portion of the beneficial interest. Again, these are generic terminologies and things that would happen at the event of a death. They also go into that suicide exclusion. You've heard that many times before, and that they would not pay that death benefit if they die by suicide within the first 2 years of this policy. It's probably one of the reasons why when you take an application, a knockout question can be if they have recently filed for bankruptcy, and if that bankruptcy has not come to a settlement so that they can go forward. First of all, if you have a bankruptcy declared when you're taking the application and they have not yet had that adjudication, you're going to get declined anyway. But once you can show them a date that has been addressed, then they'll issue the policy. But that's probably one of the reasons they don't want to issue policies to people under those conditions is, of course, because they're going to fall back into the potential of a suicide to pay off those bad debts. So again, it does have it quite clearly. That is a 2-year situation. Talks about the premium payments and how they're due at the time. Reserving the right to change the premium. It's getting into a lot of technicality here. Technically, you can't really change this premium. It's structured. You can change the structure of the premium being from monthly to quarterly to semi-annually or annually, but you're not going to actually change the premium. And again, on the term product, the cost of the insurance is already built in, so that's why it is a fixed premium for that term. Grace period, if you're not familiar with it, is the 31 days that you have from the date the premium is due to make that payment. Failure to make that payment within that grace period time will cause the policy to lapse. If the policy lapses, and that happens all the time, one thing people don't know is there is a right to come back and get it reinstated. In order, though, to get it reinstated, you still have to come back and show that there's insurability satisfactory to them, that being the carrier. And then you would have to pay back the premiums that were due from the grace period at a 6% compounded annual interest on top. So technically speaking, as crazy as it may sound, you could go back and have a policy reinstated even though it had been lapsed for 3 years, but you'd be paying a heck of a premium to do that, to correlate back to that time period. But it can be done. Again, just some terminologies that you would become familiar with. This is a non-participating product, so the premiums do not include a charge for participation in the surplus, meaning, again, it's not going to pay dividends or return back to you, or the insured, I should say. Now we get into where we really get into some detail, and we want to talk about the conversion. And they're telling you that they agree to convert all or part of this policy into a new life policy on this insured that will not require evidence of insurability. Steps that you must take: submit written application, pay that premium. Obviously, the insured has to be alive. Policy that they're converting has to be in force. And you must present that to them with the original policy that you'll be turning in to cancel. So those are the first steps involved in a conversion of a product, but most important to know that it will not require any evidence of insurability. So again, in this case, we have a term product for $1 million. As these children grow and age up, and hopefully the income and support in the family also grows likewise, perhaps anywhere from 5 to 10 years down the road, it would behoove the client to move towards a permanent product and get out of the term, and of course get the same grace of current health conditions for her insurability. They will make available permanent policies. Again, issued by them. They'll determine, of course, the new policy premium. So you will save your health condition, but you don't save age. So obviously, if you wait 5 years to do a conversion, then the conversion itself, you'll be 5 years older and the premium will be based on that. Okay. Let's see what else we have in here. You could convert all the way up to the full face amount if you chose to, but it does say if the new policy is issued for less than the original face amount, then you'll pay that annual premium obviously on that. And they also talk a little bit about the conversion credit benefits that could be allowed, and there are some, and it would be determine them. Actually, they will do the math on that and decide what types of credits one might receive based on the amount of time that policy was in force. And they come down into a little bit of the information here. The first month's deductible pay, or 1/12 of the conversion credit, would be included in the policy's cash value. So again, that's going to go back into that permanent product. And we talked about the renewability, just basically looking at the document itself to begin with. We go into the types of settlements that they could have on the product. And that would be the payment, actually the death benefit itself. So they do give them a number of options. When you elect those options, try to make those settlement decisions prior to a death, of course, otherwise it's going to be a lump sum if they haven't. Here we get into a detailed description on the actual waiver of premium, showing that the disability had been at least for 6 months. They had to have been at least 5 years of age. It had to have started with that disability at the time the rider was enforced. Here's where we talk about that disability benefit and how it excludes itself when someone reaches the age of 65. Talks about what does total disability mean. Does it mean at the time of the occupations, for the occupation that they presently are reasonably suited to perform, or being, as they show here, even being a homemaker or a student is considered engaged in a gainful occupation. So there always are details in the details. They talk about exclusions. One of the primary exclusions always is, in this case, if the waiver of premium, the disability became in effect because of an attempt to commit a felony, that's going to be excluded, or participating in a riot or any other type of insurrection or any terrorist activity. How you proceed to do that with the filing of the claim. This again would be a place where you as an agent would probably step in and assist the family, get the necessary documentations. And that, without going any further due to time, let's go over to the next rider that we added, which was the children benefit. And again, it includes all those children, whether they're legally adopted, stepchildren, or insured, who are a member of that insured's immediate family and named on that application. If they're born after the application date and they're named on the child certificate or on the birth certificate, that's the children that you can add later on if they legally adopt children. No child is insured before he or she is 7 days old. So what we're saying here is, if you do find out immediately, you're so close to your client that they had a baby yesterday, and you go in and you get the paperwork and you go visit with them and you sign the documents and get it turned in, all in 72 hours of time, the effective date for protection of that child still will be outstanding until they're 7 days old. And again, that's just a protection for the insurance company, obviously, for the potential loss in that early pregnancy or the early birth of the child. Again, suicide is excluded. And that would be, again, on that child. And here's a part that is very interesting and a lot of agents would miss. On that child term rider, there is a conversion opportunity. So before that child reaches that 25th birthday or becomes married and doesn't have the coverage anymore, you could submit an application for a new policy and convert for that child only up to, again, the face amount. So again, it's a $25,000 policy, but you could convert any child rider into a $25,000 permanent product for that child prior to the expiration of the conversion or the loss of the benefit. So that's a nice little extra that we never discussed early on, never discussed in our presentation, certainly didn't use it as a selling tool, but what it is now is it's one of the tie-down tools that we're going to take advantage of. Talks about that new policy. I won't go into all those details. I guess what you should understand, though, primarily is that when you get one of these policies, you should really take the time to study it before you go in and present it. You might want to, even in this case, highlight something like this. So during your presentation, they see all these additional benefits. The accelerated death benefit rider that we spoke about, again, that's the one that you'll find on most policies today. Gets into some of the benefit itself. Talks about some other parts of it. Let's see here where we get. Okay, for scheduling, again, we talked about the critical circumstances and the chronic conditions. In this case, we've got the acceleration due to the inability to perform those 2 daily activities, which they detail out. You might be familiar with from doing work with long-term care. Let's see, end-stage renal, coronary, more or less diagnose or definitions of things. Important, though, we get into the cancer, the difference between Insured or the invasive types of cancers and the coverage, the heart attack. Rebecca, what was the second polling question before I get too deep here? You want to throw that up for me, please? All right. Doing very well. This was a little refresher based on that child policy that we just reviewed, the benefits. And yes, all children on that policy are covered. In the event of the death of one, the policy still remains in effect for any of the other children that are on that policy. Just want to make that clarification. Thank you, Rebecca. Organs. Who was a physician? And again, this is all the detail behind all the benefits of those living benefit. When one files for one of these benefits, it is going to go through the process of the carrier making a determination of the type of event that took place, the probability of the life of that client after that event, so that the carrier makes a determination on what amount will be paid out in advance for that benefit. So you might, and again, we're going to get into more detail on how that works when we have American General Partners represent these products to us. That'll be a very important part of that presentation. And there's a part that I'm looking for that I want to bring to your attention. Well, I'm going to find it, but before I do, Rebecca, you want to throw up that third polling question for me, please? And I'm looking to see what you think about this. And you really haven't had an opportunity to know the right answer. I guess I'm just trying to find out if you have a semblance of what could be taking place. All right, so we've got about 60% participation, and 3 out of 4 people think that the benefits of these monies received will not be taxable, and 1 in 4 believe that it will. Well, that is why you're going to find in this rider an explanation. Whoops, that's the application itself, which is the last thing on the package. Is in this case, this was done as a electronic application, which is always nice because everything is typed in. So all the detail, and it would be in here that one of these health questions that was answered, not necessarily on my original Part A, Part B, which is where we are there, but perhaps, again, where the addendum becomes a part of it, and this was brought in at the later date. This is the one that we needed to sign off on because of information that was developed out of this Part B. This is the examiner's actual examination with the sign off and the examiner who did it and the date of it and all that. So that's the complete package. Thank you. Congratulations. Anyway, I got a little bit ahead of myself here, but somewhere in here they have the caveat or the knowledge that one has to have. Let's see if I can identify it off of the table of contents. It's not popping up. That I know it's in here though. So let me just explain to you what the reality is, because we're getting close on time. As you all know, the benefits or death benefit of life insurance is not a taxable event. That's one of the blessings the IRS has allowed. But the circumstances we would have here when one is being paid any of these benefits in the advance of a death, the amount of money that they paid in premium is their actual involvement in the policy. So since they are being advanced those funds and they are greater than the premiums that they've paid, that difference is a taxable event. That's the caution that you must have. And actually, when we would find it in here, it does tell them that they should seek the advice of a tax specialist or accountant regards to the benefit received at that time. I'm sorry I'm running a little late today. And the only question I had up here is the question I think I answered, which was why does that premium drop off at age 65 on the waiver of premium? And again, that's because it drops off as it would on all cases. On disability insurance, you can't even get it at age 65. Actually, in most cases, you can't get it at age 63, but the benefit would drop off at 65. Ladies and gentlemen, I'm sorry again, I ran a little bit late today, but thank you for your attention and your time with me. And again, next week, we look forward to getting again together, talk about a way at this particular point at the delivery of the policy that we're going to start attaining some additional leads so that we can go back out and start the whole cycle again. We'll follow that up with a meeting with American General Partners to discuss these benefits in greater detail. And then we'll follow that up with a meeting with North American to go over a policy review. So once again, Mark Conter signing off. Thank you very much.